Have you ever heard about the term mutual fund? Okay, so today we want to talk about mutual funds. As the name implies, the word mutual talks about something that is collective, right? So a mutual fund is a pool of monies that is owned by a couple of people, several groups of people that you would describe as investors. Now, this pool of funds are aggregated and handed over to a firm known as an asset management firm or an investment management firm. Now, these firms in turn have professional asset management experts who take these funds that have been put together by different individuals or different groups of people, and then they invest these funds on behalf of all the people who contributed these funds to their firm. And then these monies are invested. And of course, as we know in investment, anytime an investment is done, the expectation is that profits are supposed to be made. So profits are made on those investments. Now, this profit is what is now handed over to those investors who put their monies together. And of course, the asset manager who professionally manages these funds also earns a reward because, there's no free lunch anywhere in Freetown, like we normally say. So that's essentially the summary of what a mutual fund is about. Now, today we want to go into some deeper details as to how mutual funds operate. So mutual funds are, like I said earlier, are run by asset management firms, and we have a whole lot of them, in the Nigerian financial ecosystem. We have a whole lot of mutual funds. I don't want to mention names because this is not a brand advertisement video. We're not promoting any particular mutual fund, right? So there are several. Now the question is, how do I determine which mutual fund to invest in? How do I determine if a mutual fund is even right for me? So the first thing to say, we'll talk about the risk element in mutual funds. Now, mutual funds, like every investment instrument, has its own risks. Why? Because these funds are invested in mostly securities and money market instruments. Okay, so since we cannot predetermine the outcome of our investments in the stock market or in securities and what have you, and we invest our mutual funds in those securities, it therefore means that the element of risk associated with securities will also be present in mutual funds. However, it is to a lesser degree. Why? Because these funds are being managed by professionals, very well-bred professionals. Okay, so the risk is much more limited or mitigated because of the quality of the people who manage these resources on your behalf. Now, don't forget, these monies, you hand them over to the asset management firm who now invest these monies on your behalf. All right, so the risk is a lot less compared to if you were the one managing the funds yourself, particularly if you are not knowledgeable in how to invest in securities and money market instruments. So for the mutual funds, the risk is a lot lower than when it's been managed by an individual who is not very experienced or who is not even knowledgeable about securities and money market instruments. Now, even with the mutual funds, we still have different levels of risk because, your asset managers or your mutual fund managers don't invest these funds in one class of investment vehicles. So sometimes they invest these monies in bonds. In fact, as a rule, it's a combination of bonds and then stocks and exchange traded funds and the likes. Okay, so each of the different investment instruments they deploy your resources to have their own varying levels of risks. And so you find that most mutual fund managers will ask you the question, what is your risk appetite? All right. If you're very risk averse, they will tend to invest your funds in vehicles that have less risk. But again, you need to also realize that the lower the risk, the lower the returns. And then of course, they will also ask you, if you want to invest, if you have a very high risk appetite, you'll invest your funds in riskier investment vehicles. However, those riskier investment vehicles guarantee better financial returns. I hope that makes sense. That's very easy to understand. So now that we have dealt with the risk elements associated with mutual funds, I want to talk about what's in it for the mutual fund managers, because a lot of people don't understand the nitty-gritties of investing in mutual funds. Now, one of the things to consider when you're dealing with mutual fund managers is to look at what is called their expense ratio. It's important to understand what their expense ratio is, because it helps you to determine how much expense they incur in the process of investing your money. Okay, so if their expense ratio is not healthy, it means that your returns will not also be very, very good. That's very, very important. So the expense ratio, like the word ratio means, is a division of the total expenses they incur in doing the investment divided by the total assets under their portfolio. So that is what the expense ratio is. So you need to have a healthy expense ratio as a mutual fund manager for you to give good returns to your investors. Now, the other thing is the management fee. Now, as a rule of thumb, so to say, management fees are between 1 to 2% of the total investment you're committing to the mutual fund, as a rule of thumb. Now, there's something to point out at this junction. The management fee is payable to the mutual fund manager, regardless of whether they make profit for your investment or not. I think that point needs to be made. So when you're paying a management fee, you need to remember, particularly, I believe that after this video, some of you are going to take action. So when you're filling out your registration form with mutual fund managers you're going to subscribe with eventually, you're going to notice the place where they talk about management fees. You need to pay attention to that management fee. You don't want to pay a management fee that is too high, except from your research, you find out that the mutual fund actually overperforms its expectations. Now, some mutual funds promise you 18%, 19%, 20% returns, blah, blah, blah. Okay, so if you check the antecedents of the mutual funds and you find out that they overperform or they always meet up to their projections as far as performance indicators are concerned by virtue of returns. So if they have a track record of delivering or meeting up with their projections for their returns on investment, then you have nothing to worry about. So make sure that the returns more than compensate for the management fee you're paying. Okay, so if a mutual fund is charging you, say, 1% management fee and gives you a return of 15%, and then another mutual fund charges you 20% management fee, 1%, 2% management fee, and is promising a return of 22%, you're better off going for the 22% return mutual fund, because the difference between 15% and 22% in your return on investment is far, far more significant than the 1 percentage point between the management fees. I hope that makes absolute sense. The other thing you also need to remember about mutual funds is that they also earn what is called an incentive fee or a performance fee. So if they keep their word, or if their projections about their returns turn out the way they have projected it, just know that they're going to earn a performance fee of that investment they have made on your behalf. That's how they get paid. That's how they get remunerated for their services. And don't forget, it takes a lot of technicality to be able to navigate the waters of investments in stocks and securities. There's what is called alpha stocks or mispriced stocks. Some of these mutual fund managers, part of what they do is they look out for some of these alpha stocks, all right, and then they commit monies there because those stocks are undervalued. So they take advantage of the low price of those stocks. They invest monies there and then they get good returns for you and I. I'm an investor in mutual funds. And so with that, we have come to the end of this video. Peradventure you have just seen this content and you're not yet subscribed to our channel. The truth is that you're missing out on so many important pieces of information that can improve on your financial health. And so please hit the subscribe button, and then don't forget to like this video. I will be glad to have you comment on this video. Tell us 1 or 2 things you have learned. If there's anything we have said that is not clear to you or you need further directions with, you can reach out to us in the comments. We'll be glad to respond to your comments. And then don't forget that our one-on-one coaching and one-on-one guidance is still open to everyone out there. So you can sign up for our coaching so that we can hold your hand and take you through the process of investing in mutual funds and any other investment instrument you so desire. So thank you so much. Share this video with your friends. Give the video a thumbs up if you have enjoyed it. So until next time, thank you for watching and have a good time.